Afternoon, everyone. Thank you for joining. I am the CEO of Zinc. Mark Browning is my name. And this presentation, I'm very pleased to know that 80% of you are not yet investors in Zinc, because this has been prepared in anticipation of that, aimed at potential new investors. I'm going to share with you who we are, what we do, why you might consider us as part of your investment portfolio. And as we go through this little journey together, the images you see in front of you are all from our television programs and our content for brands and for businesses. This one is from our $9 million commission from Disney to make the real Top Gun. Hopefully, that title tells you what it's going to do. It's in production at the moment, and it will film through this year and eventually deliver to the client next year. They will then decide when we all get to see it. That is the real Top Gun. It's a working title for National Geographic, which is going to be on Disney+. So what does Zinc do? Well, in a nutshell, it makes some of the biggest and some of the most talked about television on our screens. We're famous really for two things: the high quality of our productions and the trust our clients place in us as their partner. So on your screen in front of you, there are a selection of programs. Some you may have come across, some you may have watched. In the case of Putin versus the West, this was for the BBC and international clients. It's on the iPlayer now. If you haven't watched it, I really, really recommend it, actually. It is a fascinating insight into how we've ended up in the position we have with this war in Ukraine. So this is about trusted access. Trusted by all the presidents, the prime ministers, the defense secretaries, the ambassadors, the five-star generals, everybody from all sides who've been involved in this conflict, including the director of the CIA, actually, in this one. Looking at others on here, so that fighter pilots program I just mentioned, that's about being trusted with exclusive access to the US Navy training facilities and their aircraft carriers. In the case of Bowel Babe, which is on the top row at the end. That was our documentary for the BBC on the story of Dame Deborah James. You may have seen it on the front cover of the Radio Times last year. It documented her journey with bowel cancer. She knew when she let us film that she wouldn't be alive to see the final film. That takes enormous trust to allow a production company into that stage of life. So trust and quality are why people buy from us. So who buys from us? Well, we work with some of the largest channels, some of the largest media partners in the world. Not only are they great for our reputation, they're obviously blue chip companies in their own right, many global players. So we have no problem with things like bad debt or anything like that. So TV production, we can come on to this later if you wish, but the economics of TV production, typically a production company is cash flowed by the client based on production milestones. So you might get a proportion of the money on the signature of the contract. You might get another proportion when you start what's called principal photography, when you get filming underway. And so it goes forward with these key deliverables and these key milestones along the way. And eventually, obviously, there's a small amount at the left when you deliver the final program. So big channels, big partners. A little bit about me. I've been in content production for nearly 25 years, previously as the director of programs at Heart London. That's the radio station in London, which has now become the Heart Network. It was formerly owned by Chrysalis PLC when I was there. Chrysalis sold it for 170 million to Global, came out of the public market into private. Off the back of that, I moved into television in 2009 as the group managing director of ITN Productions and grew their production business from a loss-making collective to a £50 million turnover production company. All organically, actually, no acquisitions along the way there. And there are quite a lot of highlights between ITN's story and Zinc's story, actually, from a loss to a profit. Will Sawyer, who is the finance director of Zinc, worked with me at ITN as well. So a similar journey. ITN and Zinc both have high quality brand recognition, high quality product, but needed better commercial acumen. So Zinc's turnaround, as you can see in the little blue box there, is now complete. Revenue has seen compound annual growth rate of 15%, including, of course, the COVID years. We started this at the back end of 2019. So now we're focusing on pushing those profits through EBITDA down to operating profit level, and that will come as our EBITDA reaches around the 2 million level, which is the market expectation for this year. And I ultimately joined here because of the value creation opportunity. Yeah, I knew how to turn around and have turned around media brands, whether they be underperforming brands like Heart or commercially distressed companies like ITN. So another media turnaround was always appealing, but this time it's about having equity in the game. And therefore, it's about alignment with shareholders, not just my alignment, but also that of the senior management team as well. We are the production company of the year based on this particular award, which is an American award, the New York Festival. I mean, it's a global award, but it's run out of New York. This includes all the big broadcasters, the BBC, some ITV companies, people like Al Jazeera, international producers. And clearly awards don't move share prices, but they are important to our people and our clients and our partners. They ultimately make us a place people want to come and work at, and they reflect well on our partners as well. So in a sense, they're kind of our soft power. They evidence our claim of being a high quality production company. And this is our last evening holding this particular cup because the next winner of Production Company of the Year will be announced over in New York tonight. So let me explain a bit about our organization and the group we are. So we are 12 businesses, 8 of which are new and have been launched as part of our transformation plan that concluded last year. In effect, we make content across a range of output. At one end, so as you look at your screen of your left-hand side, that is where our big reputational programs are made in companies like Brooklapping and Atomic TV and others. The Putin versus the Wests of this world. We call that, in our parlance, specialist factual. It's documentaries, it's current affairs, it's investigations, it's panorama and dispatches and Bowel Babe and Putin. It's those kind of programs. But we've vastly expanded our genres into factual entertainment. Through factual entertainment, that might be peak time, that might be daytime, that might be prime time. Still on television, and then you start to move from television into brand-funded content, where the brand is the funder, not the channel themselves. And out the other side of that, we move into corporate film and publishing, and out the other side of that into audio and post-production. And what we do is we sell under different types of label. And the label helps our buyer navigate their way through our group. So if you're looking for a piece of specialist factual, a high-end documentary, if the BBC is saying what's going to be on the front page of our annual report, or Channel 4, they commissioned us for this program called Gender Wars, which was really, really tricky and very reputational for them. It's exactly what they've been created for, to make programs like that. And they come to companies like us to make them. So at that end, Brooklapping, Atomic, Turn TV in Scotland and Northern Ireland. As we move into factual entertainment, Turn do a bit of that, but Rex only do that. Red Source do daytime TV. They're known for high volume television production company. Then we get into the world of Super Collider. Called Super Collider because it brings together both brands and television. So the likes of Red Bull would come to us for that. A brand wanting to make television. We have our Zinc Communicate business and the company we bought 18 months ago, The Edge, which is in brand and corporate film. And then we're off the other end towards Bumblebee, which is our post-production company, and our audio and podcasting business. But everything sits on that promise of quality storytelling and being a highly trusted partner with trusted access and trusted to deliver to our clients. Now, I joined Zinc midway through 2019. Company was running low on cash. It had a market cap of about just over 3 million, which was identical to the debt that it was held by the largest shareholder at the time. So it affected a run out of road and needed to be completely relaunched. So we recapitalized the company in January 2020, alongside this 3-year transformation plan, which had 4 objectives, which you can see on the screen. And we set out a 3-year horizon to address these 4 objectives, to sort out the margin, the gross margin story, which we did by investing in technology and in different workflows and different people, centralizing where we could so that we retained more of the money the clients spent with us. We closed some declining or loss-making businesses, and then we went on that diversification path that I've just explained, taking us into new markets, investing in new businesses and new people, and changing the culture to one that valued creativity and commercial and culture and tries to keep them all in balance. Because I believe that when creativity and commercial and culture are all working well in harmony together, you get a high-performing company. If one of those dominates the other 2, and you're just about winning awards, and you're just about doing great creative work, but you don't keep an eye on your commercial, you wobble over. Equally, in a business that's fundamentally about people and about making great programs, if you just talk about numbers all day long, people will find some other home. And without a culture that binds it all together, then those other 2 wheels don't spin properly either. So it's all 3 of those together, and that transformation plan has worked and was completed in 2022, and we see the fruits of that in 2023 and this year. So we're going to publish our annual results next week. That is going to be on Thursday morning. And alongside that, we'll issue a new trading update. So what I'm going to share with you today is to bring you up to speed on the story so far. And I urge you to join us for any of our presentations next week, where you'll then have the background and then have the latest information. So this is as of our last trading update back in February. And it's all about trading in line with expectations for 2023. Revenue has grown really strongly in the year. It's up 30% to around 40 million. And we expect next week to be reporting EBITDA climbing up to the 1 million mark. That's driven by that very strong organic growth in our TV businesses, which I'll come on to in a minute, up about 20%. The balance sheet remains strong, around 5 million of cash at the end of December. And we started this year in a very good position too. 17 million was booked when we last reported. That is not total booked, but it's booked for this year, for this financial year. Obviously, some of it goes into 2025, as I explained, with fighter pilots. Now, that's 2 million more than it was at the same time last year, heading into 2023. So all these metrics feel like they're all green and going in the right direction. And we have a healthy pipeline too. There was £5 million on the pipeline at a highly advanced stage. We have a very large pipeline, so we tend to report what's highly advanced, so that investors can kind of go, right, I know what you've booked. I know what is at the tipping point, to coin a TV show. So you'd put the 17 and the 5 together and you'd go, they're on about 22 million, or they've got line of sight of it. And we always report in the same way. So you can look back and track where we are any year, make a comparison and get a sense as to how the company is doing. So when we publish next week, have a look at those numbers, take the 17 and the 5 and have a look at what we've booked and what is highly advanced and how far that's progressed. And you'll be able to compare that to the same time last year as well. So the organic growth story is our number one priority. This is about our television business. This excludes the acquisition of The Edge, which I'll come on to in a little while. And this graph shows our organic growth of these TV businesses off the back of those investments that I've talked about that we made as part of that transformation plan. And we've grown 65% in these businesses, all organically. That's about investing in new business winning roles, in the resource that supports them, things like post-production and development. And it takes time when those new hires are made. They've got to, first of all, build their pipeline. Then they've got to win the business, and then they've got to get into production. And then it's about building that returning business to bring scale so that those businesses start to drive not just a gross margin or a top line revenue, but a gross margin, but actually deliver through the line, through the group's cost center down to operating profit. Some have caught fire very quickly. Companies like Red Source, which I put on the screen a while ago, and some are at a much earlier stage of their life cycle. That other company I showed you called Atomic TV. We only launched it this time last year. It's a Bristol-based company. But they're all generating growth, which is why we're seeing strong top-line performance. We're seeing really good EBITDA coming through now, and we'll start to see those operating profits flow this year and next as those investments unwind and start to contribute through the line. So Zinc is what we're now articulating as at initial scale. For the sake of Zinc, we're articulating this as north of the 30 million mark, because that seems to be the inflection point. Obviously, we believe we're going to be on 40 million for last year. Now, in the past 10 years, this graph shows you the journey prior to my arrival. The company was subscale. It was in that pink zone, somewhere around 20 million turnover, loss-making pretty much the whole time. Last made healthy profits long time ago, and it was a very different business then too. It's now about content that lives on screen, and it was a mixture of different things then, but it gives you a sense that scale, when it was a 60 million pound company, is when it lasted something called a healthy EBITDA. So things are going well here. Transformation plans worked. We're on track for a good set of results when we announce them next week, and we're trading well this year. So you can see we're now on a good upward trajectory. So let me talk a bit about the markets that we're in. I want to give you a sense of both the television market and the market for brands and businesses in content. So starting with TV, this graphic here and the headline is about the UK TV commissioning market for original programs. That's not acquisitions or repeats. It's a channel coming to a production company and saying, I need a new program, or I'd like you to make a second season of that program. It's an original production. Now, this 4.3 billion, this is Ofcom's these are Ofcom's numbers. That includes all genres of TV: drama, sport, kids, news, current affairs, entertainment, the whole kit and caboodle. We are not in all of those yet. We're in factual. And we talk about four types of buyer. The public service broadcasters, they're called PSBs. They're typically the main channels on your program guide, which includes BBC One and BBC Two. It includes ITV's main channel, Channel 4 and Channel 5. They're regarded as public service broadcasters by Ofcom. They're the biggest market by the volume of hours they commission. Then there's international clients, overseas broadcasters, the big US media networks spending in the UK on original production. The UK multi-channels, they will be the networks like UK TV and Dave, very fast growing, free-to-air channels. And then there's the streamers, the SVODs as we call them, the subscription video on demand, the Apple TVs, Netflixes, and Amazons of this world. So that's the total TV spend in the UK across all genres. Factual is where Zinc resides at the moment. And that is about 1 billion, about a quarter of that, but the actual addressable number, which is a number we can play in. So some of that number, about 200 million or so, is owned by, those indies are owned by existing channels making for themselves. The rest of it is the open market. So that's where sort of TV market resides in factual. And then we line up against all of those spaces. So we've repositioned the group to address all those markets, new labels, new creative business leads. So in the PSBs, that's where we get programs like Putin versus the West, which is about the reputational end of the BBC, but also we've secured our largest ever volume commission, 136 hours of television, £7 million, a 2-year commission to make Bargain Loving Brits in the Sun for Channel 5. Internationally, this is where we're seeing a lot of activity this year, a number of new big projects on our pipeline. Atomic actually has won one from an international client, its first commission since we launched it this time last year. Then we got the streamers, which is where we find those big spends. Of course, they can spend bigger because they're global. So they can actually put more pounds behind it because they've got a bigger market to get their ROI back. So as an independent production company, you get big shows from streamers, but they commission far fewer. about 20,000 hours is commissioned by the PSBs, compared to a few hundred hours by the streamers in the UK from UK production companies. So you've got to place your bets here, where you put your resources. And then there's the UK multi-channels, Dave's and Gold's and Reallys and Sky. So our Blackadder show, our Blackadder special for UK TV came from that part of the market, as did our work for Sky Arts. We've got a Gilbert and George. If you're into the art world, you'll know them for Sky Arts coming through the production. So you can see how we've deliberately, if you go back to that sort of content continuum I showed you, where all our production companies line up, they all have a space. They're all targeting part of this factual market. And we'll come on to how we might develop outside of that in a bit. The key takeaway for a company like Zinc is that we have a very small market share. The good thing about that is there's a huge upside. Even in a weak market, which we're in at the moment, we can still grow because we have a small share. Just 0.5% growth would see us increase our turnover by about 4 million. That would be growing by 20%. So we remain bullish. We remain optimistic that even in slow times and a tough UK economic market, because the share we have is small and we're making good investments and we're bringing in new people, we can grow, even if ultimately the overall market is sluggish. That's TV. Let's look a little bit about the world of corporate and brand film. It's large in the UK, but it's dominated by very small players. Only a few large established players, of which Edge, the company we bought 18 months ago, has been one for the last 30 years. Most businesses in this sector of the market are sub $1 million turnover. Edge delivered 13 million turnover into the group in its first full year as part of us. That was the highest they've ever done. They obviously like being here. So they're a big player. It's a robust market, and it's growing well, and we're very pleased with the Edge. So I'll happily take questions on any of these market issues at the end, but it gives you a flavour of where we sit. 60% of our group is in television and 40% is in content for brands and businesses. So a little bit more about TV. This is a program for Channel 4, Lenny's Laughter Class, Lenny Henry, another new series, potential returning series. And Zinc is getting talked about. It's getting talked about for all the right reasons, actually, in all the right places. Look at this brand exposure on your screen. We've got here Zinc being talked about in The Guardian, in the Mail on Sunday, in the Times, the Evening Standard, Daily Telegraph, in the UK, in the US, the big media publications, Variety, Hollywood Reporter, and so forth. You can pick up all of that news flow on our website. But this is a small AIM listed company, massively punching above its weight in terms of reputation. And it carries a lot of clout in the noisy marketplace. Zinc gets talked about, and Zinc's programs get talked about, and Zinc's investment opportunity as a result of that has a good profile. We talk in television about really only being one phone call away, as it were, from a game changer, one big game-changing commission. 35 companies have recently been shortlisted by the BBC to pilot a big new daytime quiz show. It also has the potential to run on Saturday evenings on the BBC. 35 companies were shortlisted. Zinc is one of 2 remaining. We're piloting this at the moment, so I'm afraid I can't say much about it. I put it out there really to remind us all that the day-to-day work we're doing, building revenue, organic growth, moving into new markets, is obviously what we are focused on. But the opportunity for us to win a transformational program that changes everything, that becomes a hit, that can travel globally, is one pitch away. So that is in play as we speak, and you win more than you lose more than you ever win, but you just need to win one, and a lot can change overnight. So in terms of content for brands and businesses, hopefully you've got a flavor of what factual television feels like, that unscripted, driven by access, telling human stories. That's 60% of our business, but the 40% comes from brands and businesses, is also about factual. It's about unscripted storytelling. It involves going to places, getting access to people, working with high-profile presenters, building stories and bringing them to life. And the wonderful thing about Zinc is that we can bring the power of television to brands and the power of brands to television. We've got a branded content business that brings brand money to some television programs, and it brings TV values to some brands. We have an audio and a podcasting business, which again has seen some ideas developed for audio that have become television commissions. Tony Robinson made a number of history programs for us, for Channel 5, and now we're doing the podcast version of those direct to market. Some TV commissions have become podcasts as well, and vice versa. And that, I think, is the power of being a group and bringing all of these skills together to find new money pots along the way. So let me talk a bit more about the investment case and the medium and long-term strategy. Hopefully there's a lot on this slide, but let me take you through it sort of left to right. So I've referred to our group being 60% television, production for television, 40% production for brands and businesses, but it's televisual, just doesn't sit on a channel. The buyer is a marketing director as opposed to a channel controller. So we have a mix of revenue across the edge and across TV companies, but a high volume of repeat customers. I think this speaks about the revenue quality in the group. The edge have over 80% of their business from returning customers, all blue chip companies. Same in TV, about 80% is from repeat customers. All the major broadcasters, the BBC, Channel 4, Channel 5, that might be a returning series coming back year after year, or it might be the client saying, I want another one of those you gave me last year, please. And then in terms of margins, there's a mix of margins in the group, depending on different parts. A lot of our margin, our gross margin, is over 50%. A considerable amount of TV now is over 30%, and some TV production is under 30%, and we'll do that when there is real scale opportunity, and there's just a lot of pounds on the table. We've increased gross margins quite a lot over the last few years, and the acquisition of The Edge has also bumped that up too. But when we joined, they were sub 25% in TV, and now they're well into the 30s. That moves depending in year, type of revenue that you might have. If we get more revenue from brands and businesses, which comes at a higher margin, we can do our numbers on slightly less revenue in one year. Equally, if we get a lot of big TV commissions, which are slightly lower gross margins, we'll need a slightly higher revenue number in order to do those same market forecasts. So keeping an eye on the mix of revenue will help you understand where our business is sitting. In terms of these new businesses, we've established a good reputation in the last 3 or 4 years for finding new talent and launching new businesses, but they can take years before they contribute right the way through the line. So we've launched 5 businesses in the last 3 years, all part of that transformation plan. Some are still in that growth phase. 1 or 2 have taken off. Some are not yet contributing to a net profit position, but they will in time. And you see on here, Red Source was the one we launched first. That's doing very, very well. And then Super Collider and Rex and Atomic last year. And you can see typically the investment is hundreds of thousands of pounds. Then you get a small break even at that kind of gross profit level initially. They cover their own costs in effect, but they don't contribute to being part of this group. Then they build, their profits grow, and they start to contribute. And that's why we've seen very, very fast organic growth at the revenue level. We've seen good gross margins. We're now seeing the EBITDA. And as we build, that EBITDA will come through to operating profit. At the same time, we're investing in the central core, which we call the Zinc platform. Everything we do, everything we make sits on this platform. It's all supported by a common set of infrastructure. In 2020, that was about investing in post-production. Again, to drive margins, we spent a lot of money across our group with third parties doing post-production. And it was a very simple business case to say, if we bought this kit ourselves and run it for a number of years and get the right utilization of that capital investment, we will drive our profitability. And that has been proven to be the case. So now we can operate all our TV companies, whether they be in Glasgow or Manchester or London or Bristol or wherever they happen to be, all on the same system. Centralizing finance, we've centralized IT and technology over the last couple of years, and now we're offering all our companies the marketing infrastructure and the people infrastructure to allow them to focus on what they do well, which is making as much TV as they possibly can. We're starting to be able to monetize this platform. So you'll have all come across the Russell Brand documentary. We didn't make the Russell Brand documentary. A company called Hard Cash produced that for Channel 4, but Zinc did the post-production. That company, third-party company, came to us and said, we want to buy your platform. We want you to do the post-production for us because that's the kind of television we make. And we can offer them the infrastructure and the efficiencies and the remote working and the modern infrastructure and kit that allows them to come to us. So we're starting to monetize our own platform. That's going to help grow our profitability. So I'll just finish with a couple of slides. This is about organic and acquisitive growth. So if you look around here, basically you've got two parts of our company. You've got the purple side, which is television, and the green side, which is content for brands and for businesses. Everything anchored in that central core proposition of quality storytelling, trusted partnerships, and that group platform. So what we've tried to show here is where we're strong in a market and where we're weaker, and we're very strong in factual, but we have virtually no presence in sport, no presence in sport, no presence in comedy, a little bit of presence now in factual entertainment, a little bit of presence in fact-based drama, where we use drama to reconstruct factual, but we're not in drama. We're not in entertainment yet. We could be in all of these. We could go organically, or we could go through acquisition, and we'll grow our share of the market. Similarly, in brands and businesses, we're very strong now in corporate world, corporate production and brand world. We outsource a lot of animation. A lot of our productions support events. We're not in either of those markets. We're a little bit in radio and podcasting, and we've seen the synergies. Again, we could organically invest in these. We could acquire into these. They're all adjacent to what we currently do. And we've got organic opportunities in both television. We could go faster in the US. We could diversify into different genres. Again, we could expand the edge and our corporate business. So we're keeping constantly an eye on more organic growth versus operating profit, long-term versus short-term needs, acquisition for synergies, or organic investment. So our outlook, last trading update in February, started the year well, that 17.5 number, ahead of prior year. Trading update coming next week. Look out for those key metrics. The Edge doing very well and ultimately performing in line with expectations and building that trust and confidence. Because the opportunity is there to get decent scale. This is a market that's actually quite ripe for consolidation. There are a lot of companies. Our markets are huge. Our organic growth is really, really excellent. We've done a successful acquisition and got that initial scale. So more of the same will mean we can drive this business both organically and through acquisition into a very exciting place in the years ahead. So why invest? I think it's about revenue quality, good growth, repeatability, good visibility. I think it's about delivering to expectations. For the last 4 years, we've done what we said we'd do. It's about getting scale. We now have enough scale to be profitable, operating profit, generate cash as we go through and as these investments unwind. We've done a good acquisition. Opportunities will come along for more. And there's a path ahead for genuine shareholder value creation, both for investors and for employees who are investors as well. And I urge you to follow the story as best you can. We are always talking about what we're up to, whether it be on our website or on social media. So please do join the story and learn more about us. But let's pause there or stop there and take it wherever you want to take it. Thank you.
Thanks very much, Mark, for a very interesting presentation there about Zinc. So I'll just remind delegates, if you want to ask a question, click the Q&A button at the bottom of the screen and just type in your question. Okay, we've got a couple so far. So first of all, Mike asks, what is the rationale for launching new ventures instead of just growing your existing business?
One is to spread risk and to diversify into these new markets. So that has been the plan. I mean, I think that perhaps behind the question is also the question of how long do you keep investing in, do you keep going with new things? We don't plan to launch many more new businesses. That was the transformation plan. And we rolled out, as I say, 8 new businesses over 3 years. We won't be continuing at that level. We will, in effect, be doing what your question suggests, which is growing them. But we need to look out for opportunities because, that point about scale, this is still a small business in a very large market. And the opportunity to really get gearing comes as we get to 50, 60 million turnover. So we can do that either by buying things or we can do it by organic investments. So we're trying to keep an eye on diversification. We really want those businesses to come through for us, which they all seem to be doing at the moment. But we need to keep half an eye out for what comes next.
Thanks very much, Mark. Then Philip asks, why do you think the share price has failed to discount the success that you've outlined?
Well, we've got to separate a number of things here, haven't we? We've got to separate out the wider AIM market and media stocks in general. And I would urge you to look at media stocks and compare Zinc's valuation to other media stocks, because media itself on AIM has struggled. There is an unwinding of these investments that is going to start coming through now. And I think as people start to see that EBITDA convert to operating profit, but we've been investing very hard to get this machine working, that will start to translate to an improved share price. So if people believe that the story is there and the 4 years of doing what we said we're going to do has happened, then we look to the next few years and we should be able to see good, successful growth. And you have to believe at that point that the share price will catch up with the story and will grow into our valuation. All I can do is make sure that we're running a highly effective organization and ultimately let the market do what the market does.
Yeah, that's right. It's all about execution and delivering. Thanks, Mark. Okay, a few questions for myself whilst we're waiting to see whether other delegates have any more to ask. What would you say are the secrets of running a successful and profitable production company without giving too much away?
I think I genuinely believe it's the balance of creative excellence with commercial acumen and a fine, high-performing culture. It is a people business, and it's a relational business, but it comes when they're successful, they are highly valued businesses. In terms of multiples, media companies get high multiples compared to other sectors. So, success is about building the story, building the trust, building the creative execution, building the commercial acumen, bringing in people who want to do their best work in the culture of a media group like ours, and bringing all that together. That's the difference. There are plenty of companies that do it very well, and there are some that have come off the boil. And they'll probably come off the boil because one of those 3 core elements has failed to work for them.
Thanks. And some more questions here. Can you say a little more about how the funding of productions works? How much cash flow do you have to put in?
Okay, this is, let me give you the simplest answer as I can here. So I talked about UK public service broadcasters. Their commercial model is that they approach us and say, we want a program and here's the tariff. The tariffs are fairly set for times of day and types of programs. Our job is then to make margin along the way. They will pay us a production fee. And as I say, they will cash flow that production. We also retain the rights from the UK public service broadcasters, BBC, ITV, Channel 4, Channel 5. We retain the rights to any show they commission from us to sell that program or the format of that program outside the UK. There is a quid pro quo there in that those UK PSB tariffs are less than you would get from an international streamer because you own the rights. And you can then take those rights And obviously rights are high margin because you sell the program and you sell it without having to make it again. So you make a higher margin on those. Now, the global streamers operate a different model. Because they're global, they don't offer any rights. So if you get a big commission from Netflix, you own nothing as the production company. Normally, there are obviously exceptions to this rule of thumb, but the broad principle is you own nothing. The quid pro quo there is they pay you a lot of money to make the program because you don't have the chance to monetize it through what's called the back end, through secondary rights. But you've got to be sure that you can make it, therefore, at a decent operating margin. And that's the critical thing. There are plenty of companies who've won business from the streamers, but they're either too small, they don't have the infrastructure, or they don't have the platform to be able to make programs. I was talking to a company only last week, £10 million commission, didn't see a penny of the profit because they didn't have anything to make it with. They had to outsource it all. So everything they got in, they had to spend out. So you've got to keep your eye on how good gross margins are. And we want to have a mixed portfolio where we're winning work from the PSBs at a good margin, but a lower tariff and exploiting that internationally. Equally, we're winning programs from the streamers at very high top line numbers, and we know we can make a gross margin on them to drive through to the bottom line because we're not going to get the rights. Are you on mute, or is it me?
No, it's me. Sorry. Philip asks, do you expect the content sector to continue to consolidate, or does the absence of tangible barriers to entry mean it will remain highly fragmented?
That's a good one. I think it is ready. General mood music is it's ready for consolidation. And that's partly because, you're right that there are low barriers to entry, but those are the same reasons why it's very hard to make profits at small scale. So I think while there might always be new companies that come along, and they could be actually put on this planet not to worry too much about profits, but most people have to. And the way that that will grow is companies will have to start consolidating together because it's only at scale. If you look at the widest possible selection of TV companies, look at their EBITDA, percentage of EBITDA to revenue, and it's really only the very big companies, £1 billion or $1 billion turnover companies that get their EBITDA margins up to north of 10%. Small companies under 100 million typically average about 5%. So that's why I believe that consolidation will ultimately drive this, because the market is going to need more content. At the moment, the market is suppressed and the advertisers are not spending in the way they did at the channel. So the channels have less money to spend. So they want the same content, but they want it for less. And the only way you can really drive that is by having better economies of scale as a production company.
Then could you tell us who Zinc's main shareholders are, please?
Yes, so we have we're actually in an enviable position. While I speak, I'll see if I can be so multi-skilled as to actually find you something to share with you. We have about 70% of our shareholder register is institutional investors.
Mm-hmm.
Here we go. Wow, sometimes I surprise myself. Can you see that?
Yes.
So Herald Investment Trust, Katie Potts' fund, and a concert party called John Booth are the largest shareholders. They've been with Zinc's story all the way through. But since I joined in 2019, I think Herald were the only one left who was an institutional investor. We've attracted a lot of new institutional investors, and they underwrite our stock. So Canaccord have come in, Miton has come in, Edale, Ruffer, EdenTree have come in recently. And there's John Booth on the screen I see there. It takes the concert party to 40%. So about 70% is owned by large institutional investors who understand the story, understand the market, and they are here for the long-term value creation opportunity. They're not driven by short-term dividends particularly. They're not driven by short-term share price particularly, although everybody worries about these things in the short term. Their ultimate aim, which is our ultimate aim, is to grow a business and to create a value opportunity as we go along, get some scale into the company and get a good multiple of profits coming through. Employees around 10%, and then there are smaller high net worth individuals, private investors that make up 15% or so.
Thanks. And then I'd like to ask, what should investors be looking for in your results to determine whether the company is on track? So both the ones
Yeah.
coming up next week and
Um,
going forward.
well, I'd look at the key metrics of how's organic growth doing? How much business have we booked since we last did a trading update into the year? What does the visibility look like for that pipeline, particularly the highly advanced pipeline? Obviously, make sure you understand our cash position, and yeah, make sure that gross margins are holding to the sort of levels that we have said we want to deliver at. And I kind of go, there's 5 or 6 key metrics there, alongside understanding the market and keeping an eye on the kind of programs we're making. I think if investors look out for those key financial metrics, they won't go far wrong.
Great. Okay, well, it seems that there are no further questions from the delegates here. So I'd just like to say thanks very much, Mark. It was very much appreciated, and best of luck with your venture.
Well, thank you for hosting us.